So when economists sit down to calculate national income using the income method, they absolutely do not just throw every single dollar, euro, or rupee into a giant pot and call it a day. Instead, I want you to think of the income method as a highly exclusive VIP club, or honestly, better yet, a really strict security checkpoint. Every single transaction happening in the economy has to pass through this audit. Some get the green light, and some get turned away right at the door. Today in this explainer, we're going to learn exactly how that security system is programmed. Literally, think of the income method like a strict airport security scanner. To pass this scanner and actually be counted, the cash has to be strictly tied to current, fresh production. Do a service or make a good this year, you get a massive, enthusiastic approved. But if you're just shuffling money around without creating any new value, that gets a loud rejected buzzer. It is a relentless test of true economic generation. To make sense of all this, we're splitting our audit into two halves. First, the mandatory inclusions, the stuff that gets approved, and second, the mandatory exclusions that get completely flagged. And this master map perfectly captures those two sides. We've got the green check factor flows representing real economic contributions right up against the red X audit traps, which are basically non-productive transfers and illegal gains. We'll be using this as our cheat sheet as we navigate the rules. All right, let's jump right into part one, mandatory inclusions, the approved pile. Now, what's really fascinating here is this idea of imputed values. In economics, imputed means we're estimating a value for something that feels like it maybe shouldn't count, simply because no actual cash changed hands. But to get an accurate picture of total production, these three tricky categories absolutely must pass the audit. Let's break them down. First up, production for self-consumption. Say a farmer grows a huge crop of tomatoes, but instead of taking the whole harvest to the market, they keep a bunch of those fresh veggies to feed their own family. Even though the farmer didn't literally buy the tomatoes from themselves with cash, those tomatoes still represent current, fresh production. They were grown this year using land and labor, so economists estimate their market value and stamp it approved. Next up is a bit of a mind bender. Imputed rent of owner-occupied houses. If you own your house, you obviously aren't writing a rent check to yourself every single month, but you are still actively consuming housing services. Think about it. If you didn't live there, you'd be paying rent somewhere else, or you could rent that very house out to a tenant. Because the house is actively providing a valuable service this year, the scanner detects that value. An estimated market rent is calculated and totally included. Wrapping up our approved pile, we have the imputed value of owner services. Imagine a small business owner rolling up their sleeves and doing their own bookkeeping or providing labor in their own shop. That effort has real, tangible economic value. Even though they aren't paying themselves a formal separate salary for that specific task, the estimated value of those services gets the green light. So the big takeaway bridging these two sides is this direct contrast. The approved side is strictly about real factor earnings, income generated from current labor, capital, or enterprise. The rejected side, which we're about to dive into, represents transfer incomes. That's money that moves, sure, but it doesn't actually make anything new. Which brings us perfectly to part two, mandatory exclusions. Welcome to the rejected pile. Right at the top of the rejection bin are transfer incomes and private transfers. We're talking government assistance like old age pensions, unemployment relief, student scholarships, and disaster aid. And it also covers private transfers like the pocket money your parents give you or a birthday check from grandma. Why do these get the buzzer? Because they are earned without rendering any current productive service. The money is literally just moving from one pocket to another. No fresh goods or services were created to earn that transfer. So, here's a fun hypothetical for you. If you run down to the corner store, buy a lottery scratch-off, and hit $1 million jackpot, does that massive influx of cash boost the national income? No way, absolutely not. Lottery winnings and windfall gains are strictly rejected. They are non-productive gains. Winning the lottery doesn't mean you produced $1 million worth of goods and services for the economy. It just means you got incredibly lucky in a wealth transfer game. It completely fails our core test of current production. Okay, let's try another one. You finally decide to sell your 5-year-old car on the secondhand market for 10 grand. You've got the check in your hand. Does that count towards this year's national income? Rejected again, because it didn't add to current production. Selling secondhand stuff like old cars, existing houses, or even financial assets like bonds and shares doesn't add a single thing to the current flow of goods and services. That car was already counted back when it was manufactured. Selling it now is literally just shuffling old wealth around. Also, the scanner is designed to filter out illegal incomes entirely. Profits from smuggling, underground gambling, illegal trade, all rejected. By definition, these activities are unaccountable, unregistered, and operate completely outside the formal tracked economy, so they're just excluded right out of the gate. Now, here's a kind of technical but super fascinating exclusion: interest on national debt. Under standard economic rules, government debt interest is treated as a transfer income and is excluded. The underlying assumption here is that public borrowing is usually used for consumption, not productive investment. So paying interest on that debt doesn't represent new, current production. Finally, we have to avoid the ultimate accounting sin, the double counting trap. Look at how this builds chronologically. Profits are counted before deducting taxes. Because that total profit is already safely in our approved pile, any corporation tax paid out of it has to be explicitly excluded so we don't count the exact same money twice. Same goes for wealth taxes, paid out of already counted income or past savings. They get the buzzer too. So bringing it all back to our master map, we can clearly see why the factor flows are accepted and the audit traps are avoided. It all boils down to one golden rule, the ultimate core litmus test. Did this specific transaction create a single, fresh product or service this year? If yes, it passes the scanner. If it's a transfer, an old asset, or an illegal gain, it is out. So I want to leave you with a challenge. Look at the money flowing in and out of your own wallet this week. Is it approved or rejected? Your salary? Approved. That $20 you spotted a friend? Rejected. The veggies you grew in your garden and ate? Imputed and approved. Once you view the world through this strict security scanner, you really start to realize exactly what actually drives our economy's growth. Thanks for hanging out with me for this explainer, and keep auditing your world.